You've been lied to about how wealthy people invest their money. Everything you've been taught, everything you see in the media, it's all wrong. They tell you to put your money in index funds, to invest in the stock market, to dollar cost average your way to wealth. And yeah, wealthy people do own stocks, but here's what nobody tells you. That's not where they put most of their money. That's not how they actually build and protect wealth. And once you understand where millionaires and billionaires actually put their money, once you see the real wealth building strategies they use, everything changes. Because the strategies that make people rich are completely different from the strategies they tell you to use. And that's not an accident. That's by design. So let me show you exactly where the wealthy actually put their money and why it's probably the opposite of everything you've been told. Let me start with something that's going to shock you. The average millionaire has less than 25% of their net worth in stocks. 25%. Not 50%. Not 70%. Less than a quarter. Now compare that to what financial advisors tell regular people. They tell you to put 60%, 70%, sometimes 80% of your wealth in stocks depending on your age. They tell you stocks are the path to wealth. They tell you the stock market returns 7 to 10% per year on average, so that's where your money should be. But wealthy people don't follow that advice. They do something completely different. And here's why. Wealthy people understand something that most people never learn. Stocks are great for growing money, but they're terrible for protecting wealth. And once you have real wealth, protection becomes more important than growth. So where do millionaires actually put their money? Let me break down the real allocations, because this is going to blow your mind. The largest allocation, the place where wealthy people put the most money, is real estate. Not stocks, real estate. And I'm not talking about their primary home, I'm talking about investment real estate. Rental properties, commercial buildings, apartment complexes, land. According to multiple studies of millionaire investors, somewhere between 30 and 40% of their wealth is typically in real estate. That's more than they have in stocks. Way more. And there's a very specific reason why. Real estate does something that stocks can't do. It generates passive income while also appreciating in value. You buy a rental property, you collect rent every month, and over time the property value goes up. You're getting paid while your asset appreciates. That's powerful. But it gets even better. Real estate has tax advantages that stocks don't have. You can depreciate the property even while it's appreciating in real value. You can deduct expenses. You can do 1031 exchanges to defer capital gains indefinitely. You can use something called cost segregation to accelerate depreciation. There are so many tax strategies with real estate that wealthy people use to legally reduce their tax burden. And here's the part that really matters. Real estate is a real asset. It's tangible. You can see it, touch it, walk through it. When the stock market crashes, when paper assets lose 50% of their value overnight, real estate is still there. People still need places to live. Businesses still need buildings to operate in. Real estate crashes too sometimes, but it's much more stable than stocks. And wealthy people value that stability. They value having assets that produce income and hold value even when paper markets go crazy. But here's what's really interesting. The way wealthy people buy real estate is completely different from how regular people do it. Regular people save up for a down payment, buy one property, pay down the mortgage slowly over 30 years, maybe buy another property eventually. Wealthy people use leverage aggressively. They'll put 20 to 30% down on a property and finance the rest. Then they use the rental income to pay the mortgage, so they're building equity with other people's money. And here's the kicker. They don't wait to pay off one property before buying the next. They buy multiple properties simultaneously using leverage on all of them. So instead of owning one property, free and clear, they might own 5 or 10 properties with mortgages. And the cash flow from all those properties combined creates serious income while the properties appreciate. This is how you build real wealth with real estate, not by slowly paying off one house over 30 years. Now let's talk about the second place. Wealthy people put their money, private businesses, not public stocks, private equity, ownership in private companies, and this is huge. Studies show that between 20 and 30% of millionaire wealth is typically in private business interests. That could be a business they own and operate themselves. It could be ownership stakes in other people's businesses. It could be private equity funds that buy and improve private companies. But the key is, it's private, not public. Why does this matter? Because private businesses are where the real returns are. Public stocks in the S&P 500 might give you 7 to 10% per year on average. A successful private business can return 50%, 100%, 200% per year or more. The growth potential is exponentially higher, and you have control. If you own a public stock, you're just along for the ride. You have no say in how the company is run. But if you own a private business or have a significant stake in one, you can influence decisions. You can improve operations. You can drive growth. You have agency. And here's something most people don't understand. Almost every massive fortune in history was built through private business ownership, not through investing in public stocks. Jeff Bezos didn't get rich buying Amazon stock. He got rich owning Amazon and building it. Bill Gates didn't get rich buying Microsoft stock. He got rich founding Microsoft. Elon Musk didn't get rich investing in Tesla. He got rich building it. The pattern is consistent. Real wealth comes from building or owning private businesses. Public stocks are where you put money after you've already built wealth. They're not the primary wealth-building vehicle for the truly wealthy. They're a secondary allocation for diversification and liquidity. Now here's the third place wealthy people put significant money, and this one surprises most people. Cash and cash equivalents. Not sitting in a checking account, obviously, but in money market funds, short-term treasuries, high-yield savings vehicles. Wealthy people typically keep 10 to 20% of their net worth in cash or near-cash positions, and regular people think this is crazy. They say cash loses value to inflation. Why would you hold cash? But wealthy people understand something critical. Cash is optionality. Cash gives you the ability to move quickly when opportunities arise. When the real estate market crashes and properties are on sale, who can buy them? The people with cash. When a great private business opportunity comes up but you need to move fast, who can take advantage? The people with cash. When the stock market crashes and everything's cheap, who can buy at the bottom? The people with cash. Cash is not about earning returns. Cash is about being ready for opportunities, and wealthy people always want to have dry powder available. There's also another reason wealthy people hold significant cash: protection. When you have $10 million or $50 million or more, you're not trying to turn it into $100 million by taking huge risk. You're trying to not lose it. And cash doesn't go to zero. It might lose value to inflation slowly over time, but it's stable. It's there when you need it. It doesn't vanish in a market crash. Wealthy people value that stability. They value knowing they have resources available no matter what happens. And they understand that missing opportunities cost more than inflation. If you're fully invested and a once-in-a-decade real estate opportunity comes up, you can't take advantage. You have to sell something else at potentially the wrong time. But if you have cash ready, you can move immediately. That flexibility is worth more than the 3% inflation is costing you. Now let's talk about the fourth allocation, and this is where it gets really interesting. Alternative investments. This includes things like private credit, hedge funds, commodities, precious metals, art, collectibles, venture capital. Wealthy people typically have 10 to 20% of their net worth in alternative investments. And here's why this matters. Alternatives often have low correlation to stocks. When the stock market is crashing, some alternatives actually go up. Certain types of private credit perform well in downturns. Gold and silver spike when people lose confidence in paper assets. Hedge funds using strategies like long-short equity or global macro can make money in any market environment. The point is diversification in a real sense, not the fake diversification of owning 500 stocks in an index fund, but actual diversification across different asset classes that behave differently. So when one thing is down, something else is up. This smooths out your returns over time and reduces overall portfolio volatility. And here's something most people never consider. Wealthy people invest in things that regular people can't even access. Did you know that the best performing hedge funds are closed to new investors? Did you know that the most lucrative private equity deals require you to be an accredited investor with over $1 million in net worth or $300,000 in annual income? Did you know that the best real estate syndications and private placements aren't advertised publicly? The wealthy have access to investment opportunities that regular people never even hear about. And those opportunities often have the best returns with the best risk-adjusted profiles. It's not fair, but it's reality. The game is rigged to benefit people who already have money. And once you have enough money to access these opportunities, your wealth compounds faster. This is part of why the rich keep getting richer. Now let me tell you where wealthy people don't put their money, or at least where they put very little. Individual stocks. Yeah, I know that's shocking. But think about it. If you look at millionaire asset allocations, individual stock picking represents a very small portion of their wealth, maybe 10 to 15%. They're not day trading. They're not picking hot stocks. They're not trying to find the next Amazon or Tesla. They might have some exposure to individual stocks, but it's a small allocation. And when they do own individual stocks, they're typically blue chip dividend paying companies that they plan to hold forever. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, boring, stable companies that pay dividends and have been around for 100 years. They're not chasing growth stocks. They're not speculating. That's what regular people do because that's what they're told to do. Wealthy people are more conservative than you think. And here's another place wealthy people don't put money: expensive cars and luxury goods. I know that's not an investment category, but it's worth mentioning because there's a huge misconception. People think millionaires are out there buying Ferraris and Lamborghinis and living lavishly. Some do, sure. But most millionaires drive normal cars. They live in nice but not extravagant houses. They don't waste money on rapidly depreciating assets, because they understand that every dollar spent on a luxury car is a dollar that's not invested in something that generates returns. A $50,000 car becomes worth $30,000 in 2 years. That's $20,000 of wealth destroyed. A $50,000 investment in real estate might generate $5,000 a year in cash flow plus appreciation. Over a lifetime, these decisions compound into millions of dollars of difference. Now let me break down a sample millionaire portfolio so you can see how this actually looks in practice. Let's say someone has $10 million in net worth. How might they allocate it? 35% in real estate. That's $3.5 million. Multiple rental properties, maybe some commercial real estate, maybe some land, generating cash flow and appreciating over time. 25% in private business interests. That's $2.5 million. Maybe they own a business, maybe they have equity stakes in a few private companies, maybe they're in private equity funds. This is where the highest returns come from. 20% in stocks and index funds. That's $2 million. Mostly broad market index funds or blue chip dividend stocks. This provides liquidity and some growth. 15% in cash and cash equivalents. That's $1.5 million. Sitting in money market funds or short-term treasuries earning 4 to 5%, ready to deploy when opportunities arise. And 5% in alternatives. That's $500,000. Maybe some gold, maybe some private credit, maybe some hedge fund exposure, maybe some collectibles or art. This is for diversification and inflation protection. Notice how different this is from what financial advisors tell regular people. A regular person is told to put 70% in stocks and 30% in bonds. That's it. No real estate, no private business, no alternatives, just stocks and bonds. And then they wonder why they're not building wealth like rich people do. It's because they're not investing like rich people invest. They're investing in a way that generates fees for financial advisors and keeps them safely middle class. But it doesn't build real wealth. Real wealth is built through real estate, private businesses, and intelligent use of leverage and alternative investments, not through buying index funds and hoping. Now here's the thing that nobody tells you. You don't need to be a millionaire already to start investing like one. You can start small with the same strategies. You don't need millions to buy your first rental property. You can start with a small property, maybe a condo or a duplex, house hack it. Live in one unit and rent out the other. You don't need millions to start a side business. You can start with a few hundred or a few $1,000s. Build something evenings and weekends. Reinvest the profits. Grow it over time. You don't need millions to hold some cash for opportunities. You can build up 3 months, 6 months, a year of expenses in a high-yield savings account and be ready when deals come up. You don't need millions to buy some gold or silver as insurance. You can start with a few $100s worth of coins or bars. The strategies scale. The principles are the same whether you have $10,000 or $10 million, but here's what you do need. You need to change your mindset. You need to stop thinking like a consumer and start thinking like an investor. You need to stop listening to conventional financial advice that's designed to keep you safe and broke. You need to start taking calculated risks. You need to educate yourself about real estate, about private business, about alternative investments. You need to be willing to do things that your friends and family think are risky or crazy, because the path to real wealth is not the safe, conventional path. It's the path that millionaires actually take, and that path requires courage, education, and action. Let me address some common objections because I know what some of you are thinking. You're thinking real estate takes too much work. I don't want to be a landlord. And yeah, managing properties takes work, but you can hire property managers. You can invest in real estate syndications where someone else does all the work. You can buy REITs, although those are more like stocks. There are ways to get real estate exposure without doing all the work yourself. Or you're thinking, I don't know how to start a business, I don't have any ideas. And okay, so learn. Read books, take courses, find mentors, study successful businesses in industries you understand. Everyone who ever started a business was a beginner once. Or you're thinking, this all sounds risky. I could lose money. And yeah, you could. All investing carries risk. But you know what's riskier? Putting 70% of your wealth in the stock market right before a crash. Holding all your wealth in depreciating dollars during high inflation. Not taking any intelligent risks and staying broke your whole life. That's risky too. The question is not whether there's risk. The question is what kind of risk you're taking and whether you're being compensated appropriately for that risk. Here's what I want you to understand. The wealthy don't play the same game you're being told to play. They don't put all their money in stocks and hope the market goes up. They invest in real assets that generate cash flow. They build and own businesses. They use leverage intelligently to multiply their returns. They hold cash for opportunities. They diversify into alternatives that most people never even consider. And they do all of this with a long-term perspective focused on building and protecting wealth, not on trying to get rich quick. This is the real game. This is how wealth is actually built, not through some secret stock picking strategy, not through day trading, not through cryptocurrencies or meme stocks, through boring, proven, time-tested strategies that wealthy people have been using for generations. And here's the final thing I want to say. The information is out there. The strategies are known. You can learn all of this. You can start implementing these strategies in your own life, regardless of where you're starting from. But most people won't. Most people will keep doing what they're told. Keep putting their money in index funds and hoping for 7% returns. Keep working their job and living paycheck to paycheck. Keep wondering why they're not building wealth like rich people do. And the reason is simple. They're not willing to do what rich people do. They want the results without the work. They want the wealth without the risk. They want the freedom without the sacrifice. And it doesn't work that way. Building real wealth requires education, discipline, courage, and action. It requires doing things differently than most people do. It requires investing like millionaires actually invest, not like you're told to invest. So, here's my challenge to you. Look at your current investment allocation. How much is in stocks? How much is in real estate? How much is in private business? How much is in cash? How much is in alternatives? Does it look like a millionaire portfolio, or does it look like what some financial advisor told you to do? And if it doesn't look like a millionaire portfolio, why not? What's stopping you from investing like wealthy people actually invest? Is it lack of knowledge? Then go learn. Is it lack of capital? Then start small and build up. Is it fear? Then educate yourself until you understand the risks and can manage them intelligently. But do something. Because continuing to invest the way you're investing now, if it's not working, if you're not building wealth, doing more of the same won't get you different results. You have to change the game. You have to start playing by the rules that wealthy people actually use. And once you do that, Once you start investing like millionaires actually invest, everything changes. Your wealth starts growing faster. Your cash flow increases. Your options expand. And over time, you build real wealth, not paper wealth that vanishes in a market crash. Real wealth, real assets, real income, real freedom. That's what's possible when you understand where millionaires actually put their money and you start doing the same thing.